Hi guys, thanks for taking an interest in Wall Street Odds. This video will go over the theory behind Wall Street Odds so you understand why we built it and how you can get the most out of it. First, it's important to understand what we designed the platform to help you with. 1. To prioritize your trades by using our real-time odds. And 2. To generate new trading ideas through our top odds lists. First, I'll walk you through prioritizing trades by leveraging our real-time odds. So if you're deciding what to buy among some trade ideas you're already considering, looking at each stock's odds of going up and its historic average return could help you rank your ideas and make it easier to choose which one of them to go through with. Next, if you're looking for new trade ideas, our curated top odds list provides you 6 lists, 3 buy lists, and 3 sell lists. Within these lists, we've included the stocks that have historically moved up the most after a move equivalent to today's move, and the stocks that have historically moved down the most after a move equivalent to today's move. We'll dive deeper into the different lists in another video. So, what is the purpose of analyzing historical stock return odds? Well, in the stock market, the past can be predictive of the future. That is the premise of several trading strategies. Any sort of technical or chart analysis, for instance, is based on the notion that certain patterns tend to repeat themselves over time. This stems from the fact that price patterns are linked to traders' behavioral tendencies and biases. And since humans are yet to rid themselves of behavioral imperfections, these patterns are prone to repeating themselves. Any quantitative or quant trading strategy is also founded on the notion that the past can help predict the future. The Medallion Fund, for instance, the best performing fund in the world, led by Jim Simmons, has posted an average annualized return of over 66% since 1988. And their trading strategy is 100% quantitative and fully based on exploiting patterns in the stock market that have played out historically. So much so that once the algorithm for the trading is set, there is virtually no human interference. With that being said, this is a perfect time to talk about 2 key points that separate a great quant trader and a quant hedge fund, like the Medallion Fund, from the poor ones. Firstly, history is not a perfect predictor of the future. Even if you have uncovered a historic pattern, it is likely to only give you a small edge on any given trade. Secondly, a small edge can compound into a massive advantage over time. Understanding point A is crucial to not blowing up as an investor. When you understand point A, you limit your investment size on any given trade to only a small portion of your portfolio, and you also take into account other variables that may affect the stock's price, such as a company's fundamentals. Although the Medallion Fund is 100% quant-based, most hedge funds do take the approach of using both historic patterns while also taking into account other factors when making an investment decision. However, some novice investors that get involved in quantitative trading strategies get carried away thinking that the past is a perfect predictor of the future, and they end up allocating all their money on every trade they make. This may pay off for a while, but eventually it leads to almost all of their portfolio being lost on one trade. Point B is also massively misunderstood by amateur traders. They do not grasp the magnitude of how powerful a small edge can be over time. You might be surprised to learn that the Medallion Fund, for instance, is rumored to win in only about 51% of their trades. That's right, the world's greatest hedge fund only makes a winning trade just over 50% of the time. However, because they make thousands of small trades a year, this compounds massively over time. So when you see a historic pattern that has played out in the past 100% of the time, it likely will not play out 100% of the time again in the future, but if you think there is now at least a greater than 50% chance it will play out in the future, this is still very advantageous. Now that we have established how analyzing historical stock returns can be beneficial, let's discuss the 2 specific patterns that our odds primarily help you identify: momentum and reversals. Some stocks demonstrate strong momentum tendencies, meaning there are some stocks that historically are more likely to move up even more if they're already moving up, and likewise move down even more if they're already moving down. Danimer Scientific would be an example of a stock that has demonstrated this tendency in the past, when it was up 5.5% during a trading day. As you can see, the other 45 times it has been up 5.5% during a trading day. If you had bought it at the moment it was up exactly 5.5% and sold it at the next day's close, you would have made a positive return 67% of the time. Other stocks demonstrate strong reversal tendencies, meaning they are historically more likely to move up if they have just experienced a down move, and vice versa. Open bank on trading days when it is down 6.3% would be an example of that. These two anomalies are thought to be caused by certain stocks being traded by groups of investors that regularly over and underreact to news and other items that affect the stock price. That being said, most stocks' moves on most days don't demonstrate any correlation with past returns, so for these stocks on these days, knowing how the stock has behaved in the past is less useful. RAD is an example of that when it's up 3.7%. Wall Street Odds shows you what has happened historically to help you identify the stocks that have historically had the strongest reversal and the strongest momentum tendencies. All that being said, there are many factors that influence the stock's price on any given day. So you will likely get the best results by using our data along with other fundamental and or technical data. Something to keep in mind is that if an earnings release or any other material event with an unknown outcome is set to take place during the time frame you are analyzing on our platform, our data will likely be less helpful as the outcome of that event will likely be the main driver of the stock price. Likewise, during days that the market indexes are behaving significantly more volatile than usual, our odds are likely to be less helpful as the general market gyrations are likely to have a greater impact on the stock's price for that day. That concludes this video. If you want to get a better understanding of our odds, please watch our odds explained video. Please email us if you have any questions, comments, or suggestions. Thanks for watching.